Hey, good morning. This is Mayor Valensky with Driving Markets. I hope you're all well. So first of all, just a couple of corrections for those viewers who think one viewer thought I was a taxi driver. No, that's not the case. I'm not a taxi driver. I'm actually just a commentator on financial markets. No, I'm not a taxi driver, so that puts that one to rest. And the idea of Driving Markets, just to recap on those new viewers, is that to give a quickly market summary wrap while driving. So I called it Driving Markets, giving the report on markets while driving, so that any viewers who are confused, that is really the idea. That's why it's called Driving Markets. Okay, let's continue and let's see where we're at regarding financials as of last week. So the markets moved up on Thursday and Friday on the back of some solid consumer confidence, but based on the retailers reporting some very good solid earnings. So that gave further confidence to investors to come back into the market, simply because what happened is that they see that retail sales have not been impacted by higher interest rates or by inflation or by any damage whatsoever to consumer confidence, and that has boosted investors' resilience to get back into the market and buy up those shares, and that pushed markets up. The Dow, the S&P, Nasdaq, European markets all jumped up on the back of that confidence. The question is, where's the confidence coming from the consumer, especially in the US? Well, there's a hell of a lot of money lying in consumers' bank accounts. That's mainly from either the furlough schemes or from the pandemic stimulus packages that all these consumers got, whether in the States, in the UK, or in Europe, and that's further boosted the overall money available to go out and spend. Now, where does that put us in regards to inflation? So if you think about it, if the consumer is out there and they're spending, which is what they're doing at the moment, then that is going to further add oil to the inflation fire. Why is that? Simply because as consumers consume, and the prices will rise, and there's a limit on what we can supply due to the lockdowns in China and the pandemic, then that's going to add more substance to the inflation fears. So longer term, or near term to longer term, we're going to get significant inflation. I've been saying for a long time, the major factor that people seem to ignore or miss out on is the fact that inflation is going to get higher, and whatever's being reported is simply the wrong numbers. They are based on a very limited number of products in a basket of goods. So you can expect inflation to go super high, which is what I'm expecting. And furthermore, what you do have is you will have rising interest rates. Now, the Fed has already stated clearly that as regards June, July, there'll be at least two rates of 0.5%. There's a consensus of opinion across the Fed from all presidents in the Fed. All governors of the Fed have stated there's going to be a 50 basis point rise in June, July, and maybe in August. Well, what I'm saying is there's probably going to be a 50 basis point rise all the way to the end of the year. As much as the central banks are concerned, their main concern is that they don't really want to damage the economy, but the economies overall are going to go into a recession. It's going to happen. It's odds on favorite that that's going to happen. You're going to have a recession either by third quarter or by last quarter of the year. Depends on which country, which jurisdiction we're talking about. So what's likely to happen regarding overall markets and overall property? Now, property lags the stock market by about 12 months. So even though you've seen high asset values in the property market, what's likely to happen over the next 6 months, 12 months, you'll see a decline in properties. As rates rise, the values of the properties will drop because the market will come off a hell of a lot. There's a huge bubble being created in property over the last 10 years due to cheap money, and that's likely to pop. It's very, very speculative of what's happened in the property market due to zero interest rates, and as rates rise, you're going to have a property downfall. The same with the stock market. The stock market's going to fall over the next 12 months. I expect to see the S&P down 40%, the Nasdaq down another 30%, and the Dow down another 25-30% over the next 12 months. That is very likely to happen with rising interest rates and rising inflation. Notice the yields on the bonds didn't move that much on Friday when the market's going up, and that is a cause of concern. You would expect the yield to significantly rise on the back of a rising stock market, but it's not. So it's a foreboding sign. As regards Bitcoin's moved sideways, and that's also a big red flag. Bitcoin is a risk appetite asset, and therefore investors would have got into it under normal circumstances, but it's not a good sign that did not move up with the rest of the market. So Bitcoin is a big red flag. Looks like it's going to come off a lot more, well down to the 20,000 level in the very near future. Meir Walensky, Driving Markets. Catch me on Instagram, Twitter, WhatsApp. Have a good day.